You get the offer. The salary is pretty good. The title might be better than the one you have now, and then they mention the part that's supposed to make everything exciting: equity. They tell you you're getting in early. They talk about growth. The founders have a vision. Everyone seems energized. And if things go according to plan, those stock options could someday be worth a lot of money. But there's another possibility. They could be worth absolutely nothing. That's the trade-off when you join a startup. You're not just choosing a job. You may be trading stability for opportunity, salary for equity, and predictability for the possibility of something much bigger. That can be a fantastic career move. But before you leave an established company or turn down another offer, you need to understand exactly what you're signing up for. Today, we're covering 5 questions to ask before joining a startup. Because getting in early sounds exciting. But early also means you're accepting some of the risk. Now, let's begin. Question number 1. How financially healthy is the company? Before you evaluate your job offer, evaluate the company. Startups can look incredibly successful from the outside. Great website, beautiful office, growing team, impressive announcements, but none of those things tell you how much money the company actually has. Ask, how is the company funded? Has it raised outside capital? Is it generating revenue? Is it profitable? How quickly is it spending money? And here's an important word to understand: runway. Runway is essentially an estimate of how long the company can continue operating at its current spending rate before it needs additional funding or revenue. If a startup has enough cash for 24 months, that's very different from one that needs another funding round in 6 months just to keep operating. You may not get access to every financial detail, but you can ask reasonable questions. For example, how is the company positioned financially for the next 12 to 24 months? Or, what milestones need to be achieved before the next funding round? Pay attention to the answer. You aren't looking for guarantees. Startups don't come with guarantees. You're trying to understand the level of risk you're accepting. Question number 2. What is my equity actually worth? This is where startup compensation can get confusing. Someone tells you, "We're giving you 20,000 stock options." That sounds impressive. But 20,000 out of what? If the company has 1 million shares, that's one thing. If it has 100 million, that's something very different. So don't focus only on the number of options. Ask, what percentage of the company does my grant represent on a fully diluted basis? What is the vesting schedule? What is the exercise price? What happens to my options if I leave? Could future fundraising dilute my ownership? And what would need to happen before I could actually turn those shares into cash? This is important. Equity is not salary. Your salary arrives in your bank account. Startup equity represents the possibility of future value. The company could be acquired. It could eventually go public. Your shares could become extremely valuable, or the company could fail, and the equity could be worth nothing. So when evaluating the offer, don't mentally spend money that doesn't exist yet. Treat startup equity as potential upside, not guaranteed compensation. Question number 3. What am I giving up to take this job? Maybe the startup is offering you $120,000 plus equity, but your established employer pays $140,000. At first you might think, it's only a $20,000 difference, but keep going. What about your 401k match? Annual bonus, health insurance, stock awards, paid time off, pension, tuition reimbursement, job stability? Now multiply those differences over several years. Suddenly, joining the startup may represent a much larger financial investment than you realized. You're essentially betting some portion of your current compensation on the startup's future. That doesn't mean you shouldn't do it. It means you should know the size of the bet. Ask yourself, if the equity eventually becomes worthless, would I still be comfortable with the decision I made? That's a powerful test, because if the job only makes financial sense if the company becomes enormously successful, you may be taking more risk than you realize. Question number 4. What will working here actually be like? Startup culture gets romanticized. Move fast, build things, change the world. No bureaucracy, everyone has influence. and sometimes that's exactly what it's like. But fast-moving environment can also mean priorities change constantly. Job descriptions are flexible, processes don't exist yet, resources are limited, hours can be unpredictable, and the project you spent 3 months building might suddenly disappear because the company changed direction. Ask, what does a normal work week look like? How often do priorities change? What happened during the last major setback? How does leadership communicate difficult news? What is employee turnover like? And here's one I particularly like. Why did the last person in this position leave? Listen carefully. You're trying to determine whether you would enjoy working in an environment where uncertainty is normal. Some people thrive in that environment, others hate it. Neither is wrong. The important thing is knowing which person you are. Question number 5. Will this opportunity still be worth it if the startup fails? This may be the most important question. Imagine you accept the job. You work there for 2 years. You give it everything. Then the company runs out of funding. Your equity is worth 0, and you're looking for another job. Was joining still worth it? Maybe the answer is yes. Perhaps you learned new skills, built products from scratch, managed a team, worked directly with executives, built an incredible professional network, entered a new industry, or gained experience that would have taken 5 years to acquire somewhere else. That's why startup opportunities shouldn't be evaluated only by their chances of becoming the next billion-dollar company. Ask, what happens to my career even if this company doesn't succeed? If the experience itself makes you more valuable, then you have another form of return on your investment. But if you're sacrificing salary, benefits, stability, and career development purely for the possibility of a huge equity payout, understand exactly how much you're gambling. Today's final thought. Joining a startup is neither good nor bad. It's simply a career and financial decision with a different risk and reward equation. For some professionals, startups provide faster career growth, greater responsibility, valuable experience, and potentially significant financial upside. For others, the lower compensation, uncertain funding, demanding workload, or lack of stability may not fit their financial situation or lifestyle. Before joining a startup, ask: 1. How financially healthy is the company? 2. What is my equity actually worth? 3. What am I giving up to take this job? 4. What will working here actually be like? 5. Will this opportunity still be worth it if the startup fails? Because the goal isn't simply finding the company that could become the next big thing. It's making sure joining that company makes sense for you, even if it doesn't. In closing, if you found this helpful, subscribe to Quick Financial Concepts. We break down real financial decisions so you can avoid costly mistakes and make smarter money moves. And remember, startup equity can give you tremendous upside. Just don't confuse the possibility of future wealth with money you already have.